Welcome to the Allan Small Financial Show. I want to thank everyone for taking time out of your busy week to share that time with us here today. We do these shows every other week or every second week so that we can help you, the individual investor, help you with your investment decisions. Basically, make sense out of what's going on in the world today. There are a lot of cross currents. There are a lot of information out there that's floating around on the internet. A lot of economists been speaking lately, central bankers been speaking, investment advisors. There are a lot of, mixed feelings about what's going on in the market. So this show is here so that I can answer some of your questions and make sense out of what is happening. We also like to have from time to time some guests appear on the show and give us their perspective. Over the next few shows, we're going to have some really great guests. Patricia Lovett-Reed will be with us, as well as Dan Kelly from CFIB. So we're going to have some really good guests in the month of September and into October. So hopefully between what they have to say and our shows and what we're going to be addressing, we can really, bring home what's happening in the markets today and why it's happening and make sense out of it for all of you, the individual investor. So on the show today, we're going to be doing what we always do. We do our This Week component where we talk about what individual investors need to know over the next 5 to 10 business days. We're going to actually do that right off the bat because I believe there are a few topics there that are quite important and definitely moving markets, especially as of the last week or so. We're also going to talk about central banks, this idea of a soft landing or maybe a hard landing. What does that mean? And what do I believe is possible at this time? Uncertainty and investment strategy. There's definitely a lot of uncertainty out there for investors. What type of investment strategy am I recommending and have I been using over the last, let's call it the last 8 months or so? Market volatility. I think we've all seen this over the last few weeks where markets are up maybe a few hundred points before the market opens. Some economic data is released or somebody says something, and all of a sudden the market drops significantly. We saw that just the other day, or actually yesterday, when the markets were poised to open up 200 points. And by the end of the day on the Dow Jones, they were down 1,300 points, one of the largest declines we've seen. I think the 7th largest decline we've seen ever. So this market volatility, what's causing it, and how can we manage money during this volatility? And lastly, your questions. I want to answer your questions. So if any of you have any questions while you're listening to the show or watching the show, please feel free to type it into your little box on YouTube, the YouTube Live or Facebook Live. I'd be happy to answer as many questions as I can at the end of the show. So as I mentioned, we're going to start with the This Week part of our show. And this is where I like to talk about what I believe is important for individual investors to consider over the next 5 to 10 business days before they make their investment decisions. I'm going to talk about economic data. This is probably the most important part of this segment. We're going to talk a bit about what we've seen recently with regards to inflation data, what we're going to see with respect to other economic data, GDP, housing, consumer spending, consumer sentiment. These are all going to play a factor in how the market behaves or reacts over the next 5 to 10 business days and beyond. We're going to also talk a bit about, has the market already factored in the current interest rate hikes that we've seen so far and the potential rate hikes that we could see down the road? The United States is about to raise rates again this month. We've already seen Bank of Canada raise rates. What do we predict or project they're going to do? And has the market already factored in this rate increase? And lastly, price of oil. Price of oil continues to be important. We've been hearing time and time again how the Europeans are struggling as the Russians stop the flow of natural gas and oil to the European area. And really, the sanctions that have been put on by the West in general on Russia. And now they've turned around and said, well, if you're going to put sanctions on us, we're not going to allow for natural gas to flow to places like Germany. So how is that going to play out over the coming months as we get into the fall and winter season, when the temperatures fall and you need natural gas to heat homes, to heat businesses, to produce goods? And so the price of oil is definitely important, and we're going to touch on that as well. So without further ado, let's start with the first topic, economic data. And I think we have a couple of charts we can put up regarding the economic data. It's been crucial as we've seen the markets react substantially to it. Here you can see how the markets have been on a pretty significant slide, high inflation readings that we've seen, and you've seen the markets really tail off. They've come back a little bit towards the end of that chart over the last week or so, but unfortunately, the gains of this past week have been taken away from us as of yesterday, when I guess we saw a bit higher or a bit hotter inflationary data out of the US. We saw inflation fall to 8.3%. We were expecting or hoping for an 8% reading. I was actually hoping to see a number that starts with a 7. I think that would be great. But because we got a little bit hotter inflationary data out of the US, we saw a tremendous pullback in the markets yesterday. As I said earlier, the 7th largest pullback we've seen for the markets ever in the US. And as we move forward, we're going to see, or we're going to hear the Fed speak in the next week or two about their interest rate hikes that they're going to put through. It looks like a 75 basis point hike is in the cards, but many are now calling for a full percentage point. We're also going to get data on GDP and growth in general. As interest rates move higher to combat inflation, what does that mean for GDP? And I think it's very important for individual investors to look at this economic data as it comes in to assess. And we know good economic data usually means it's bad for the market, and bad economic data actually means some good things for the market. I think we have another chart to show here regarding some economic data. So here you can see inflation data. As you see, the inflation numbers have really spiked higher as we moved into 2022. You can see a bit of a pullback on the blue line, and that is inflation in general. But when you strip out and you look at core inflation, which strips out very volatile energy prices and food prices, you can see core inflation really hasn't fallen much. So inflation is still a very important for the Fed. Obviously, that's what they're basing their interest rate policy on. And as we move forward, all the other economic data will be as very important to see what path the Fed will take in raising interest rates. The second topic that I think is important for individual investors to consider as they make their investment decisions is, has all of these interest rate hikes, have they already been factored in? And I think we have a chart on the market, and we can see once we put that chart up that the market actually is starting to make higher lows. And what I mean by that is, you can see it here. If you look at the low that we saw mid-June, that was kind of the low point for the market. The S&P 500 was in and around 3,600 points. Again, I use the S&P 500 because it is the largest index in North America, a lot larger, obviously, than the TSX, Toronto Stock Exchange up here, or the Dow, or even the NASDAQ. So I always like the S&P, and that's what a lot of us money managers look at. And if you notice, it pretty much a pretty steep rise from mid-June till about, let's say August, probably mid-August. And then we saw a decline from mid-August. We saw a bit of an uptrend in September. And now, as of yesterday, gave back most of the gains there. But I guess what I'm looking at, and what a lot of traders are looking at, are we starting to make higher lows? So if we saw the market pull back on the S&P to about 3,600 in June, and then the next pullback only took us down to about 3,900, and then perhaps the next pullback that we see may only take us back down to 4,000 or 4,100, we're starting to see a pattern where the market will be starting to move from the lower, the lower left to the top right, and the peaks and valleys will see some nice peaks, but the valleys or the declines won't be as great. And that's when you start to see a channel going the other way. So a bit of technical talk there, but the bottom line is this. if we don't start to see, or if we can start to see, I should say, let's think positively, less of a decline going forward. So the declines are a little bit less and less as we move forward. I think that is a catalyst and a spark for this market. And I think individual investors should take notice of this. If the lows are not as pronounced and less deep, less sharp, I think this is a signal to the market, signal to investors, and we could see investors coming in and buy this market again. So let's look to see if a lot of these interest rate increases are starting to be baked in to what the market is doing. Lastly, oil. And interesting, I was talking to somebody recently, and we have a chart of oil to show you the price of oil, how much price of oil is falling. And obviously all the sanctions that have been placed on Russia, you can see how much oil has fallen down to about $88 a barrel. The Russians obviously cannot sell oil, or not selling oil anymore, to the West, or selling very little of it. So who are they selling to? Well, they're selling to India, places like China. And that's been a positive for Russia and the price of oil in general. But recently, China has gone into a fairly large lockdown. They've locked down a number of cities, a number of people again. And what this has done is diminished the demand side for the price for oil in general. So if I think it's something like 300 million people are being locked down in China, the demand for oil and energy products would be less. So what does that mean? Well, that means that the supply-demand equilibrium is starting to come more into shape. And the demand is now perhaps getting closer to what we have in supply. So we're seeing the price of oil fall because the demand for oil is falling. So in some funny way, even though China is buying oil from Russia, which is not helping with the overall inflationary situation in that way, we're actually seeing, because of their lockdowns, they're helping on the demand side, and we're starting to see the demand for oil fall, and that's why we're seeing the price of oil fall, which will help inflation going forward. So keep an eye on the price of oil. Will we see the price of oil spike as China stops their or removes their lockdowns? Will we see the price of oil spike as we get into the colder months, November, December, and into January? That will be key to keeping inflation down or stopping it from rising back to the highs that we saw early on. So for individual investors, again, keep your eye on the price of oil. For many individual investors, if you've been watching the business shows, whether it's BNN or in the US, CNBC or Bloomberg, you've been noticing they've been throwing around terms, central banks, soft landing, hard landing. Can the central banks negotiate or navigate this economy to have a soft landing, or will it have a hard landing? And I thought we'd talk about a bit about this today, because it is so prevalent in some of the conversations that we're hearing on TV. So what is a soft landing or a hard landing? And the best way to explain that is, if you're on a plane and you're about to land on a runway, you obviously want to have a soft landing on that runway. You don't want to have a hard landing or come in really steep and have a really bash and crash kind of landing. So that's the same for the market. We're noticing that the market is falling, and we all know that over the first, let's call it 8 months of the year, we've seen negative numbers for the markets right across the globe. But as the central banks continue to raise rates, and at some point when they stop raising rates, or at least slow the pace of that rate increase, will the economy be able to get back on its feet? Will the stock market be able to turn around and begin to move higher quickly? Will they have a soft landing? Will they be able to bounce back in a soft landing situation? Or will the market have a hard landing? Will interest rates rise enough to take our economy, to take the US economy as an example, into a recession, a deeper recession, whereby we have a hard landing scenario where it takes the economy and the stock market a lot longer to rebound? So that's kind of what the terms mean. I'm still hopeful for a soft landing. I do believe that as interest rates continue to increase, it becomes more and more difficult to navigate or to create this soft landing scenario for central banks. And I think that's why the market has sold off as much as it has over the course of this year, because when you look at history, it's been very difficult when we look back at previous Federal Reserve governors and Federal Reserves and governors in general to negotiate or navigate to create this soft landing. We tend to see more of a hard landing situation. And as interest rates rise, I guess investors become more and more disillusioned and upset, thinking that a soft landing is probably not going to happen. And we may see the worst case scenario, or at least a worst case scenario, which is a harder landing where the economies, both Canada and the US, go into perhaps a deeper recession. I don't think that is the case. I believe we will see a bit of a soft landing. I think the US is already in a recession, but a very shallow one. It's possible that Canada could follow into a shallow recession, but I think it's going to be one where we bounce back very quickly. So I'm more in the camp of a soft landing. And again, we should continue to look for information coming out on this type of approach, whether we're leaning more towards soft or hard landings going forward into the future. There's a lot of uncertainty out there, as we know, and I think a lot of it is quite confusing. And I try to talk a bit about it every show. We've talked about good data, bad data, what it means for the stock market, and I think a lot of that has been very confusing for investors. When we see great jobs growth, 500,000 jobs created out of the U.S., we see the market fall, and we're wondering, well, why is that? We want to see job growth. When we see GDP growth, when we see consumer spending money, this is all good news for the economy, for all of us, yet the stock market sells off. And investors just can't seem to get a handle on why that is. And to be honest, I think it's quite silly, the fact that the market sells off when we do have some strong data. However, it does make sense from the standpoint of what the Federal Reserve and Bank of Canada are trying to accomplish. They're actually trying to slow down our economy. They're trying to get businesses to stop expanding. They're trying to get businesses to stop spending, to get individual investors or the consumer to stop spending. They want to see this economy slow down in general. And I know that might be weird for people to hear, but that is what they're trying to do. You see, a lot of what's happening with respect to inflation, unfortunately, has been due to the supply side. We can't find enough oil. We can't get enough supply of labor, for example, and that's a big one. And so we're seeing inflation rise because of those two things. I would say oil has probably been more important to the rise of inflation than labor, but labor has been pretty important as well. So what the Fed can do, what the Fed can only do to fight inflation, is to raise interest rates so that they can dampen the demand, to bring it in line more with the supply that is available, supply of goods, supply of labor, supply of energy. So what they're going to do is they're going to slow down our economy. Now, the Fed has this, I guess, very difficult task of balancing everything, right? They want to slow the economy, but not slow it too much that it puts us into some sort of deep recession, hard landing scenario. But they do want to see a slowdown. So under this type of environment, what type of investment strategy have I been using? What have I been recommending to my clients and investors in general? Well, in my opinion, I think you need to take a contrarian approach. When things are falling and they're good quality investment ideas, I think that's when you have to look at buying those investment ideas. Some names that pop into my conversations on a regular basis are names like Amazon, names like Microsoft. These are some of the biggest companies in the world. They're good for defensive purposes. And they're usually the first names to rise when things turn around. And I've named these companies in the past. And yes, they haven't really gone back up as yet from their recent falls, but you can look at a name like Amazon today, down about 32% from its high, Microsoft down just under 30% from its high. There are a lot of good quality banks. There are a lot of good quality semiconductors or chip makers, a lot of good quality retail names, a lot of good quality names in general that have fallen, that if you look at why they have fallen and the type of business that they have been doing, you could clearly see why they would be a good investment for a growth portfolio. And there are obviously a lot of other types of investment ideas, such as bonds, that have now become more attractive as interest rates have gone higher. So overall, I think with regards to the uncertainty of the stock market, why it's been confusing for investors, I think that's when you really need to lean on the services of an investment advisor. Ask them what they think should be going on, or what you should be doing. They should have strategy, have an approach. My approach simply is to buy when those are fearful. That is the best time that you can buy, in my opinion, because that's when you're going to get the bargains. And those that have the iron stomach to be able to buy when things are lower at these points in time, 12, 24 months from now, I think you're going to be handsomely rewarded for owning some of these great quality names, leaders in their industry, large cap, dominant names. And I think that's the strategy, in my opinion, individual investors need to use as they navigate through these crazy times. Volatility, as you can see it there, the big word. It's something that is talked about so often. Uncertainty, volatility. They actually created an index, which we have a chart on, the CBOE, the VIX index, which shows volatility. And you can clearly see that when the volatility index starts moving towards 30, and you can see it here. I think it's down today, but it just recently as high as 27, approaching 30. That's when kind of the alarm bells go off and everybody starts to get very nervous about the volatility in the market. And you can see how much it's come down really since July, and it started to peak back up in September. And we all look at the volatility index because that gives us a good indication on how jittery investors are, how jittery money managers are, because the volatility is a great measurement for this. And we've seen a lot of volatility recently in the middle of the day. You're sitting here, you're watching the market up 100 points. Today I'm looking at the market today. At one point, I think the Dow was up over 100, the Nasdaq was up over 100. Now the Dow's only up 50, Nasdaq up 80, TSX is still doing well. Markets are moving around every second of the day, but we've been finding that over the last few weeks, you tend to get these points in time throughout the day that we see a huge swing in the market, a huge downfall. And we saw it yesterday, and it happened to come at the beginning of the open, but we've seen it where somebody says something middle of the day, someone that can influence the markets like the Federal Reserve or an economist, or maybe something in geopolitical, like something coming out of Russia or China, and all of a sudden we go from couple of 100 points up on the Dow, or maybe 100 points up on the Toronto market, and all of a sudden we go into negative territory. And this is the volatility that I'm talking about. And a lot of people will ask me, how can investors be selling? Why are they selling? They're selling at a low, they're getting out. What's going on? And my answer to that is investors aren't selling. It's not the retail investor that's doing the selling. These are computer trades that are doing the selling. There are computerized programs out there, algorithms, and I talk about them all the time, and they're designed to pick up on the headlines of the day. If they're negative, then the market will sell. If they're positive, then the market or the computers will buy. And these trades are done so rapidly that you see these swings happen so quickly. If you turn your head away from the computer for a couple of minutes, market could drop 50 to 100 points. And that's on the Dow or even sometimes on the TSX. And that's how quick these things happen. So when you're looking at the market and you're seeing these types of movements, stop and think about what I'm telling you today. It's not the average retail investor like you and me. It's the computers, it's the programs. And sometimes you just got to take a step back and let things run its course, like I did yesterday. I really didn't make many trades yesterday. How can you on a day that's so volatile? So you kind of take a step back. Some people have this 1-day rule, 3-day rule when they see big swings in the market or big losses in the market. I tend to look at it as take a step back, maybe at the end of the day, see, maybe I want to nibble a little bit or maybe buy in the next day. But I think the best course of action, the best strategy, when you see volatility as pronounced as we have seen, and you see that VIX index spike up to close to 30 or in the high 20s or even beyond 30, I think that's when you got to take a step back and understand that tomorrow's another day and there's a good chance cooler heads will prevail and maybe we'll see a rebound in the markets. And maybe that's when you start to nibble once the selling slows down. Now's the time on the show where I take your questions. And we had a question come in at the end of last show I didn't get to. And I'm actually just going to read it. Here is this question came from, I think, from Facebook on the last show. It says, hi, Alan, how should I use the triple Qs ETF? Thank you. So for those that don't know what the triple Qs are, it's an ETF or an index, and it basically follows the NASDAQ, if you will. And how can you use the triple Qs? Well, we know the NASDAQ this year right now is down about 28-29% from its all-time high. It has been the worst performing index in North America. So if you are taking a contrarian approach, perhaps you look at buying the triple Qs ETF if you don't want to be a stock picker. I tend to be more obviously a stock picker. I'm here to pick winners and losers. Not everything on the NASDAQ will rise. The NASDAQ is not only made up of tech stocks, it's also made up of other things as well. But overall, tech makes up the most of the triple Qs. So if you want to just play the tech space in general, then maybe you just go and buy the ETF, the triple Qs, rather than trying to pick a Microsoft or a Google or a Meta, Facebook, and not knowing which one to choose. Pick the index, and if that index were to rebound as we saw in July, that could be a very profitable investment. Let's take another question here. I think we have some more time. With rising interest rates, with interest rates rapidly rising, what are some good bond products to look at? We tend on our show to talk very little about bonds, although I think in shows to come, we're going to delve more into bonds because bond yields are rising, right? With rising interest rates on bonds are now rising and they're becoming a more viable investment. So what are some good bond products? Well, I think corporate bonds, good quality A-rated corporate bonds make sense for most investors. Most investors look at bonds as the low risk side of their portfolio. And so you really don't want to buy anything less than investment grade if bonds are making up the low risk side of your portfolio. So I think good quality corporate bonds is what I've been looking at for my individual investors. For those that can handle some more risk, you may want to look at maybe some B-rated bonds. They tend to pay higher interest, of course. And I think with the market as it is today, with short-term bonds paying sometimes even more than longer-term bonds, as the bond curve or the interest rate curve, yield curve has been inverted for quite some time. So lower duration bonds are paying just as much as or more than higher duration bonds. I think you could buy some short-term bonds that will pay you a pretty decent yield for now. But keep in mind, of course, making 4.5% on a bond when inflation is still 7% in our country, you're still going to be losing of 2.5% with respect to real rate of return when you factor in inflation. And if it's outside of a registered plan, you have to pay some tax on that. You may lose half of that to tax. So bonds are still not a great place if you're looking for growth. I think we have some time maybe for one more question here. I like this one. It's an interesting one. Are you open to topic ideas on your show? If so, how can I contact you with an idea? That's a different question. I thought I'd bring that one up. And that's a great question. Definitely open to ideas for the show. We do a show every couple of weeks. So sometimes ideas are difficult to come by, especially when the topics for the show and the topics that are important to individual investors haven't really changed much over the past, I guess, few months or even 6, 7 months. We seem to always be talking about inflation and interest rates and oil and what's going on with that, the Federal Reserve, Bank of Canada. These topics haven't really changed much. So if there's a topic out there that anyone watching today would like to see me discuss, send me a message. You can always email me, go to my website. My email's there. You can send me an email, give me a call. Let me know what's important to you, because that's why we're doing the show. We want to address what's important to the individual investor and answer questions that you may have. So I think that's all the time we have for today's show. But once again, I want to stress that we have some great guests coming up in the next few shows. Patricia Lovett-Reed will be on with us on our next show. A lot of you know Patty from her time at CTV as a chief financial commentator over there. She was on CP24 for quite a while. So we'll have hopefully a great chat on what's going on in the world and what's going on with respect to the stock market, inflation, and all the fun stuff. So please tune in a couple of weeks, and I look forward to seeing everybody in a couple of weeks. So good luck, and as I always say, happy investing.